At this very moment, there are three entries stored inside your bank's computer system that you agreed to long ago and have never revisited since. They aren't fraud. They aren't a scam phone call. They are completely routine settings. A checkbox you selected when you first opened the account, a phone number you provided back in 2004, a card number you gave a utility company for an automatic payment. Nobody at the bank is ever going to pick up the phone and warn you that those outdated settings have quietly become dangerous. They simply sit there doing exactly what you instructed them to do until the day a stranger discovers them first. Over the next several minutes, I'm going to take you through the three bank records almost every senior forgets to update, exactly what each one costs a family when something goes wrong, and precisely how to correct all three before a single dollar moves anywhere. Hey, I'm Lana Maines. I'm no expert, but I'm here to give you straightforward, practical financial information that helps you hold on to more of what you've already worked hard to build. So if that's valuable to you, go ahead and hit subscribe, because I break down exactly this kind of thing every single week. One setting, one form, one loophole at a time. The first record that almost nobody thinks to examine is the connection between your checking account and your savings account. Banks refer to it as overdraft protection, and they market it to you as a convenience. It's presented as a way to avoid the awkwardness of a declined card at the supermarket or a bounced check to the power company. What the promotional brochure never actually says out loud is that this convenience silently constructs a direct automated bridge between the account you use every single day and the account where you actually store the money you absolutely cannot afford to lose. Without that connection in place, a compromised checking account simply runs empty and stops. The damage is confined to whatever cash happened to be sitting in checking at that point in time. With the connection switched on, the instant checking reaches zero, the bank's own systems step in and begin automatically pulling from savings to keep covering whatever is still charging against the account, including every fraudulent transaction. The bank isn't being breached a second time. It is doing precisely what you authorized it to do years ago for an entirely different reason than the one it's now being used for. This is exactly what happened to a woman I'll call Margaret. She's 71 years old, lives just outside Chicago in the brick bungalow she and her late husband purchased back in 1988, and manages her own finances carefully now that she's on her own. She balances her checkbook by hand, keeps her doors locked, and maintains roughly $14,000 in her primary checking account, set aside for property taxes and her Medicare supplemental premiums. One Tuesday morning, she used her debit card at a neighborhood gas station where a nearly invisible skimming device had been installed directly inside the pump, thin enough to go completely undetected. Nothing happened for almost 2 weeks because professional fraud operations rarely move quickly. They bundle stolen card numbers by the thousands and sell them overseas in large batches, waiting for the right window of opportunity. A $112 test charge appeared on day 13 simply to verify the account was still active and the bank's fraud detection hadn't flagged anything suspicious. Margaret never saw it. She reviews her paper statement once a month at her kitchen table. She doesn't use a banking application. 2 days after that test charge cleared, the real draining started. An electronics purchase, a batch of online gift cards, a transfer to an offshore payment processor. Over roughly 3 weeks, $8,400 moved out of her account while she tended her garden and visited her grandchildren, completely unaware of what was happening. Her statement cut on the 15th was processed and printed by the bank and arrived in her mailbox on the 20th, 5 full days after it had even been generated. On top of the 3 weeks that had already passed while the theft was actively underway, by the time she sat down at her kitchen table on a quiet Sunday afternoon and traced her finger down the column of charges, the damage had already been done. She called the number on the back of her card, sat through an automated phone menu, and was informed that a fraud investigation would be opened with a federally mandated window of up to 10 business days before any provisional credit would even be considered. In the meantime, her property tax check bounced, her automatic electric bill payment failed, her account was frozen while the investigation moved forward, and she had to borrow grocery money from her daughter. And here's the part that matters most when it comes to this particular record. Because her savings account was linked to checking for overdraft coverage, the bank had already begun quietly pulling from that savings balance to keep the fraudulent charges clearing before she ever picked up the phone. What should have been a contained loss limited to whatever cash sat in checking that month became a much larger one simply because of a setting she had agreed to years earlier and never thought about again. Correcting this particular record requires one phone call. You tell your bank you want to formally opt out of any overdraft coverage that draws from a linked savings account. Under the Electronic Fund Transfer Act, that request is a right you already possess, and the bank cannot legally refuse it. They will read you a prepared script warning about declined transactions and returned item fees. Let them read it. A declined charge at the register is a minor inconvenience you can address right on the spot. A drained retirement account is not something you address on the spot. A declined transaction in this specific situation is quite literally your last active line of defense once every other safeguard has already failed. The second record most people never think to revisit is the list of automatic payments still quietly running on a debit card. Take a moment to consider how many companies actually hold your card number on file for a set-it-and-forget-it payment. The electric company, the cable or internet provider, a streaming subscription you signed up for years ago, maybe a Medicare supplemental premium or a life insurance policy. It's convenient, which is precisely why almost nobody ever goes back to look at it. But merchant databases get compromised constantly, and when a retailer or subscription platform gets hit, hackers rarely leave with just one card number. They leave with millions of them all at once, in bulk. Because your card is already connected to recurring charges on that account, a fraudulent transaction sized to resemble a normal utility bill or a routine subscription renewal can slide right past a bank's automated fraud filters without triggering a single alert. It blends in seamlessly with everything else on the page. By the time anyone actually notices, the reporting window has frequently already closed and the money is simply gone for good. There's also a slower, quieter version of the same problem. Banks periodically reissue debit card numbers, sometimes following any reported breach, and every single merchant holding your old number on file has to be updated one at a time, manually, by you. Miss even one and either a bill silently fails to process, generating its own late fees and the risk of a service interruption, or worse, an old number that should have been fully deactivated still carries just enough life left in the system to be exploited before the bank finishes shutting it down completely. A quieter version of this same problem has nothing to do with hackers at all, and it's worth mentioning here because it hides in the exact same list. A free trial signed up for years ago converts into a small monthly charge that nobody remembers agreeing to. A streaming service raises its price $1 or $2 every year, and the increase never gets questioned because the total still looks roughly like what it always looked like on the statement. None of that qualifies as fraud in the legal sense, but it lives on the same debit card, buried in the same list, and it compounds in precisely the same way. A little at a time, unnoticed until a full review of the list turns up 2 or 3 subscriptions nobody actively uses anymore, sometimes adding up to $50 or $60 per month in charges nobody would actively choose to keep paying if they were looking at the list with fresh eyes. Fixing this record is a Sunday afternoon project, not a phone call. Pull your last 3 statements and physically list every company drafting your account automatically. For anything currently pulling from a debit card, log into that account directly and switch the payment method over to a credit card instead. A fraudulent charge there draws against the bank's money first, not yours, while any dispute gets worked out. And you're never actually out your own cash while the investigation is ongoing. For anything that must pull directly from a checking account by routing number, such as certain insurance premiums or a mortgage payment, consider routing those specific payments through a small separate checking account that holds only enough to cover that particular month's bills, kept entirely apart from your primary savings. If that secondary account is ever compromised, a thief can only reach whatever happens to be sitting in it for that month, and your actual life savings never enters the picture at all. It's worth asking honestly why a bank would ever allow a setting this risky to remain switched on by default for years without a single check-in conversation. The answer isn't complicated once you examine the incentives involved. A debit card transaction is enormously profitable for a bank because it collects a swipe fee from the merchant on every single purchase while carrying almost none of the risk itself. A credit card is the opposite situation entirely. The bank is extending you its own money for 30 days. So if that card is stolen, the loss lands on the bank's balance sheet, not yours. That's precisely why debit cards get handed out by default the moment you open a checking account. Why banks dangle cashback offers and round up savings programs to keep you swiping them daily. And why so few institutions ever proactively call a longtime customer to say, you may want to take another look at that overdraft link you set up back in 2004. There is simply no financial incentive on their end to start that conversation. Closing these gaps has always quietly been left to the account holder, whether or not anyone ever explained that expectation up front. The Federal Trade Commission's own fraud data supports this plainly. Consumers lose billions of dollars to fraud every year in this country, and bank transfers along with direct payments consistently account for some of the largest total losses of any category tracked. Older adults are disproportionately targeted for a fairly straightforward reason. Decades of steady saving means there is simply more sitting in the account to take. And a continued reliance on paper statements over real-time banking applications builds in exactly the kind of reporting delay that a 60-day liability clock is practically designed to exploit. None of that reflects poorly on anyone's judgment or attentiveness. It's simply how the incentives line up on both sides of this equation. And understanding that reality is most of the battle when it comes to deciding to close the gap yourself rather than waiting on someone else to do it for you. A bank will always meet its minimum legal obligation once fraud has already occurred. It has considerably less reason to help you prevent that fraud from happening in the first place. And that gap between the minimum required response and genuine prevention is exactly where these three records tend to sit unnoticed for years at a stretch. So here's what I want you to do. The exemptions, the breaks, the refunds most seniors already qualify for but never claim. I've put them all together in one place, state by state, form by form, so you don't waste hours digging through government websites. Everything is laid out quickly and simply, so any senior can find exactly what applies to their situation. No matter which state you're in, there is money you're leaving on the table. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now stay right here, because the third record is the one that quietly costs families the most money of all. And it's the reason I made this entire video. Before we get to the third record, it helps to understand why this problem exists in the first place, because the answer explains almost everything else covered in this video. A credit card and a debit card sit side by side in your wallet, look identical, weigh exactly the same, and slide into the same machine at checkout. But legally, they are governed by two entirely different laws written a decade apart, with two completely different assumptions built into them. Congress passed the Truth in Lending Act back in 1968 when credit cards were expanding rapidly, and built it around a straightforward idea. A credit card represents the bank's money. If someone steals a credit card number, they're taking an unsecured loan from a major financial institution, and that institution has every incentive in the world to pursue it, because every dollar stolen comes directly off its own bottom line. Liability for the cardholder was capped permanently at $50. A decade later, in 1978, Congress wrote a separate law for the emerging world of ATMs and point-of-sale terminals, the Electronic Fund Transfer Act. But a debit card doesn't move the bank's money, it moves yours. The bank is a custodian in this arrangement, not a lender, and its legal obligation is procedural rather than financial. That one difference in the underlying law is the reason one card in your wallet protects you almost completely, and the identical-looking card sitting right next to it does not. That difference is exactly what happened to a retired teacher I'll call Harold. He had $22,000 sitting in his checking account after selling a classic car. A hotel reservation database breach exposed his debit card number, and on the 10th of the month, a hacker ran a small $20 test charge against a fake online charity. It landed on a statement mailed out on the 15th, buried on page 3 between a hardware store receipt and a grocery bill. Harold missed it entirely. Federal law gives him 60 calendar days from that statement date to catch and report an unauthorized charge before his liability protection expires, and that clock quietly began ticking the moment the statement was mailed out, not the day he opened the envelope. The hacker did nothing for 2 months because professional fraud rings understand this exact deadline far better than most consumers ever will. 6 days after Harold's protection lapsed, they returned and moved $19,000 out of his account in under 48 hours because he had missed that first $20 charge. On paper, every dollar taken after the 60-day mark was gone permanently, with the bank under no legal obligation to return a single cent of it. Run that identical scenario using a credit card instead of a debit card, and the math flips entirely. Same hacker, same hotel breach, same $20 test charge, same $19,000 theft 2 months later. Under the Truth in Lending Act, Harold's liability stays capped at $50 regardless of how many days have passed, because a credit card draws on the bank's money rather than his own, and the law treats it accordingly. There's a second layer of protection built on top of that cap as well. Under the Fair Credit Billing Act, Harold would have had the right to formally dispute the charges and withhold payment on the disputed amount while the investigation ran its course, meaning he never has to hand over a single dollar of his own cash while the matter is being sorted out. His checking account and the $22,000 sitting inside it would never have been touched at all. That's the entire distinction between the two cards sitting side by side in the same wallet. One asks the bank to absorb the risk it is actually built to absorb, and the other quietly hands that same risk straight back to you. That brings us to the third record, and it isn't a number or a linked account at all. It's how your bank is actually permitted to contact you when something goes wrong. If your bank is only mailing you a single paper statement once a month, you are by design always going to be closer to that 60-day cliff than you realize, because an entire billing cycle can pass before you even see the first indication of trouble. Call your bank and turn on real-time transaction alerts by text message or email for any withdrawal above a small threshold you set yourself, something like $25 or $50. Most banks can configure this during the very same call as the overdraft change, without requiring you to download or learn a new mobile application if that isn't something you're comfortable with. A plain text alert sent to an ordinary cell phone works exactly as well as a push notification through an app. That single change converts a 2-week blind spot into a same-day notification, and it costs absolutely nothing to set up. It is quite simply the fastest and least expensive fix on this entire list. While we're on the subject of staying ahead of a problem rather than cleaning up after it, a few additional things are worth knowing because they rarely come up in the same conversation as a bank statement. You're entitled to a completely free credit freeze with each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, which prevents new accounts from being opened in your name without your direct approval. And it costs nothing to place or lift whenever the need arises. Each bureau must be contacted separately, since freezing one does not automatically freeze the other two. The Federal Trade Commission operates a dedicated reporting portal specifically for this kind of theft at reportfraud.ftc.gov. Filing a report there creates an official record that can matter considerably if a bank drags its feet on an investigation it's required to complete. The Department of Justice also operates a national elder fraud hotline staffed specifically to help older adults navigate reporting and recovery following this kind of theft, entirely at no cost. Staff there can often point you toward the correct next step more quickly than a general customer service line ever will. And if a bank denies a legitimate claim outright or slow walks a Regulation E investigation past its own 10 business day window, the Consumer Financial Protection Bureau accepts direct complaints against the institution itself, a route that tends to get a bank's compliance department moving considerably faster than a second call to the regular customer service line ever would. Keep a simple written log of every call you make throughout any of this, including the date, the representative's name, and what was promised, since a bank's own notes on a file are rarely as thorough as the record you can maintain yourself. One more record is worth mentioning briefly, even though it falls just outside our main 3. Most banks and brokerage firms now allow you to designate what's called a trusted contact on the account, someone the institution is permitted to reach out to if they notice unusual activity or a sudden pattern that resembles exploitation, without granting that person any access to the money itself. It costs nothing to add, takes about 5 minutes over the phone, and gives your bank one more legitimate avenue to catch a problem early instead of watching it unfold in silence for 2 months. Two related records get overlooked just as frequently and deserve a mention here as well. If you've added an adult child to a checking account as a joint owner years ago purely for convenience during an illness or a trip, that person retains full access and full liability exposure on the account indefinitely, long after the original reason for adding them has passed. It's worth reconsidering whether a joint account is still the right tool or whether a limited power of attorney would accomplish the same convenience without leaving another name permanently attached to every dollar in the account. And if a power of attorney is already on file at your bank, it's worth confirming the branch actually has the current version on hand. Banks sometimes retain an outdated copy for years after a family updates the document with an attorney, which can create real delays at exactly the moment a family member needs to step in and assist. A quick call asking the branch to pull up whatever document they currently have on file and compare it against the most recent copy in your own records takes only a few minutes and closes a gap that otherwise tends to surface at the worst possible moment, usually during a hospital stay when nobody has the time or composure to sort through paperwork discrepancies with a bank. A quick example of what it looks like when these three records are actually corrected in time is worth sharing here. A retired postal worker I'll call Ruth had the exact same overdraft link Margaret did, the exact same forgotten debit card autopays, and the exact same paper-only statement preference. But her daughter had watched a video almost identical to this one and spent a Saturday afternoon walking her through all three changes. 4 months later, a merchant Ruth had a streaming subscription with was breached, and a fraudulent charge appeared against her card. Within days, because real-time alerts had been switched on, she saw the text message that same afternoon and called her bank before the sun went down. Because overdraft coverage from savings had been turned off, the charge simply declined once it exceeded what remained in checking, and nothing beyond that ever moved. The entire incident cost her roughly $40 and about 20 minutes on the phone. Nothing about her situation was different from Margaret's, except that the three records had already been updated before the fraud ever arrived. So let's bring the whole thing back together into a sequence you can actually follow this weekend, because updating three records is genuinely a single afternoon of work, not a project that stretches on for weeks. Begin with a single phone call to your bank about overdraft settings. Tell the representative directly that you want to opt out of any overdraft coverage that draws from a linked savings account, and ask them to confirm the change in writing either by email or through your online account messages, so there is a clear record that the request was actually processed and not merely noted verbally. Move next to your automatic payments and treat it as a brief audit rather than a memory exercise. Pull your last three statements side by side and write down every company drafting your account automatically, along with the amount and the date it typically hits. For anything currently pulling from a debit card, log into that specific merchant account and switch the payment method over to a credit card. For anything that must legally remain tied to a checking account and routing number, move that particular payment to a small separate checking account holding only enough to cover that month's bills, kept entirely apart from where your real savings actually lives. Finish with your alert preferences and be specific rather than general when you set them up. Ask your bank to enable real-time text or email alerts for any single withdrawal above a threshold you select yourself, whether that's $25, $50, or whatever number makes sense given your typical spending patterns. While you're on that same call, ask whether a trusted contact can be added to the account, since it costs nothing and takes only a few extra minutes once the representative already has your file open. None of these calls involves a fee. None of them requires a lawyer or a financial advisor to carry out on your behalf. Every single one of them shifts risk away from your family and back onto the institution that is actually equipped, staffed, and legally positioned to absorb it. None of this is about distrusting your bank, and it isn't about assuming the worst of anyone working behind the counter. It's about recognizing that the default settings on your account were written for a version of banking that existed decades ago, back when a stolen wallet was something you noticed the very same afternoon and a monthly paper statement was the fastest way anyone had to check their own balance. Banking has changed dramatically since those settings were first put in place. But the settings themselves rarely get revisited once they're switched on, especially on an account that's been open for 20 or 30 years and has quietly outlasted the branch manager who originally opened it. Nobody is going to come and update these 3 records for you. And no employee at your branch is evaluated on how much risk they identified and removed from your file before you walked in the door. That responsibility has always quietly belonged to the customer, whether or not anyone ever bothered to say so out loud. This matters most at exactly the moments in life when it's hardest to think about. Right after a spouse passes away and the mail begins piling up on the dining room table. During a hospital stay when statements sit unopened for weeks, or during a long winter trip when mail forwarding runs behind schedule, those are precisely the gaps a 60-day clock is designed to exploit. And they're also precisely the moments when nobody has the mental bandwidth to think about a banking setting from 2004. That's exactly why this is worth doing now, on an ordinary week, while nothing urgent is demanding your attention and there's nothing competing for your focus. You've spent decades building what's sitting in those accounts. An hour this weekend, handled on a calm day rather than a difficult one, is genuinely all it takes to make sure 3 outdated settings can't quietly undo it later. Take care of yourselves and go check those 3 settings this week.